Hey class, coming live to you from Mackinac City, Michigan. Just want to give you a few notes on capital investment analysis, particularly on how to do the problems. So capital investment analysis is about spending large amounts of money, maybe to buy some new equipment that's going to help you produce some new product or something. So you want to make sure when you spend that money that you can earn a return on it. So there's 4 methods that I give you about capital investment analysis. 2 of them I'm going to ask you to do a problem on, so we're just going to talk about those. They're called the cash payback method, which is a non-present value method. And then there is the net present value method, which is a present value technique. On the cash payback method, what we're looking for is something called the cash payback period, and that's simply the number of years that it takes to return our investment. So if we make an investment of $100,000 and that investment will generate $50,000 worth of net cash flow in year 1 and $50,000 of cash flow in year 2, we're going to add those 2 amounts together. 50 plus 50 makes 100. That's a return of our investment, and that is our cash payback period. That is the answer we're looking for. It's a 2-year cash payback. And on the cash payback period, our cash payback method, we're looking for shorter time frames to be better. So if there was an investment that required a 4-year cash payback period and an investment that required a 5-year cash payback period, the 4-year one would be better because it was a shorter time period. Now moving on to the net present value method, we're going to have to do a few more calculations on it. We have to use the present value tables that are located in the back of your book. It's in Appendix A, and in that appendix you'll find 2 tables. It's really the present value of one, which is what they call the present value of a single amount, and then there's a table called the present value of an ordinary annuity. You use the present value of an ordinary annuity table when you have an annuity amount, which means like the net cash flow from year 1 is $10,000. The cash flow from year 2 is $10,000. The net cash flow from year 3 is $10,000. That's an annuity. It's an equal annual amount. You'll want to use that table when you have equal annual cash flows. But I think the problem I give you, it's got unequal cash flows, so you really won't have to use that one. So you'll spend most of your time on the present value of a single amount. And so when you use that table, when you have a cash flow of like net cash flow in year 1 of $10,000, a net cash flow in year 2 of $15,000, a net cash flow in year 3 of, let's say, $8,000. So it's unequal amounts each year. You use the present value of a single amount or present value of a single amount table, which is in Appendix A again. So the way you really use that table, if you were to go and look at it, companies would say, hey, we want to make sure we make a 10% return, minimum return. So you would go to that table, and you're going to need to find the 10% column, and for each year, underneath that, you'll see for like the 10% column in year 1, the amount is .0909 something. I think I got that exact amount here. I think I wrote that down somewhere. Yeah, .90909. And then in year 2, you'll see that the present value discount amount, or what we call the discount factor, is .82645. So you need to be familiar with that table, and we're going to go in and use those discount factors to calculate what's called the present value amount. So the way we'll use that table, if you look at your example, is I gave you a company that's going to need a 12% minimum return, and they've got net cash flow in year 1 of $50,000, year 2 of like $32,000. So the way that we're going to do the problem on net present value is we're going to set up a table similar to the one I've given you, and we're going to go in and look at the 12% column, and in year 1 we find that the discount value for that single amount is .893, And in your book, I think it gives you a few more numbers. I just didn't have them down this morning when I was doing up your notes. But we'll look at that, get that discount factor there, and we're going to take 50,000 times 0.893, and that's going to give us a present value of that future cash flow, that 1 year cash flow. What it's worth today is $44,650. Then we've got to go to year 2, and you'll see that the cash flow was $32,000. You're just going to multiply that times 0.797, and you'll find that the present value of that cash flow that's 2 years out from today is only worth $25,504 in today amounts. And you'll do that for each of the 4 years. You'll find we'll need to find the total present value, and the way you do that is add up the 4-year amounts, and that totals to $94,314. And then in the example, I said the investment was $107,000. So you're going to take 94, subtract out 107, and you find that you get a negative net present value of $12,686. Now, that is the problem in itself. You found the final answer, but this is not a good answer. What we hope to find is that the net present value technique when we do it, or that net present value method when we do it, that we find a positive net present value. Okay? Positive net present values imply an acceptable project, meaning that they have earned a return that is greater than the minimum rate that we desired. So back to our example, it was a negative amount. So that means that this investment returns less than a 12% return. So this would not be an acceptable investment for our $107,000. We'd try to go find a different investment to use that money for. Now, I know this is kind of a quick example. I hope that with this example and with reading the notes that it makes sense. If not, you can shoot me another email, and maybe next couple of days I can get another little video out for you. But capital investment analysis, we're not going to make it hard, just trying to let you be familiar with there are some methods that are out there and give you exposure to a couple of those methods of evaluation. So until next time, I'm saying goodbye from Mackinac City, Michigan, and y'all have a great day.